RMDs, RBAs, IRAs. There's an alphabet soup of abbreviations when it comes time to tackle how to take money from individual investments. Luckily, Jim Lineweaver lettered in financial acronyms, and he's here to give us a few money-saving lessons. Jim is a certified financial planner professional with the Lineweaver Financial Group. So welcome back to the show.
Good to see you again.
So instead of the ABCs, we're starting with the RMDs.
Right.
What are those?
Well, they're called required minimum distributions. And unfortunately, when the government allows you to tax defer your money through your life for your retirement, at some point in time, they're going to be knocking on your door to get their money back. And this is the magic rule of 70 and a half, that if you have qualified assets like 401ks and 403bs and 457s and stuff, you're going to have to start paying Uncle Sam some money back.
All right. So the RMDs apply to our IRAs.
Yes, and it could even be if you had a simplified employee pension plan, or maybe your employer had a simple IRA, or these other retirement plans that I talked about. The majority of them just think that if you had deferral all your life, you're going to have to start taking money out at 70 and a half.
Okay, so we turn 70 and a half and we immediately run to the bank and yank out our distribution for that year.
That's what you think, and a lot of people do, but that's really not how it works. You have to come up with what's called your required beginning date of when you're going to have to take these required minimum distributions. And I think an example would probably work best for your viewers because it can be kind of confusing.
Okay.
So let's say you turned 70 and back in September 30th of last year, and so therefore you're 70 and a half this year. So March 30th is when you turn 70 and a half. Now you'd think this year I'd have to start taking a distribution, but technically you don't. You don't have to until April 1st of 2019, so you could defer it this year. The problem is if you do, then you're going to have to take that distribution by April 1st of 2019 and take another one by the end of the year. So therefore you could take two, and it might jump you up into another bracket, or maybe have you pay more money on your Medicare premiums and things along that nature. So I think it's best for most people to do it, say, in 2018 in this example, and then another one in 2019 and continue that each year thereafter.
Okay, so after your first required beginning date, then after that, every other distribution has to be by the end of the year.
Yes, and let's say you don't do it. Let's say you made a mistake. Well, unfortunately, the IRS does not like that. So they're going to give you a 50% penalty on what you didn't take out. So if you had a $10,000 distribution you had to take out, and you only took out 5 by the end of the year, you're going to get 50% penalty, or $2,500 you're going to owe the IRS because you didn't take out that full $10,000.
That seems excessive.
It is.
So any other changes that the new tax laws brought in with regard to this alphabet soup?
Yeah, not directly, but indirectly it created quite a bit of problems because most people's standard deductions doubled, which means you're not going to itemize as much anymore. Well, those people that were cutting checks to charities and their church and things and were deducting that, well, guess what? With this standard deduction, you might not be able to do it. So what a good thing might be able to do is to just pay directly from your IRA. Don't take the money yourself. Work out with the IRA custodian and have that paid directly to the charity, non-taxable event, still keep your standard deductions double what they were last year, and now you can not only get that full write-off, you're also not going to pay any taxes on your required minimum distribution.
Oh, wow. It all sounds very confusing, but you're going to spell things out, right, at a complimentary seminar?
We are. We have an education class on this coming up because there's a lot of other impacts that this tax law has on required minimum distribution. So we have it on Tuesday, January 30th at 2 p.m., also Thursday, February 1st at 2 p.m. at the Brecksville Community Center. And things do fill up fast, but it will be free for your viewers, so if they'd like to attend, just have them give us a call.
All right. Sounds good. The money in your IRA may be yours, but the government tells you when it's time to start taking some out. That's your RBD. And how much to take out, that's your RMD. To understand all of these acronyms and how they can impact your investments, attend Jim's seminar or give him a call. The number's next.
To find out more, call the Lineweaver Financial Group at 1-888-313-4009 or log on to www.lineweaver.net.